And with that, we're now about to get started with another round of interaction on the core sectors, expectation versus reality, and also roadmap to reforms. Ladies and gentlemen, I'd like to invite our esteemed set of speakers to please take their seats on the dais. May I please invite Mr. Ashish Singh, Managing Director and Head of India, Principal Finance Real Estate, Standard Chartered Bank, to please come forward. May I also invite CA Atul Gupta, Central Council Member with ICAI, and Mr. Samir Kanabar, who is a tax partner with EY India. Ladies and gentlemen, can we have a round of applause to welcome our final set of speakers as they interact on this very relevant topic that we had just mentioned. Also, ladies and gentlemen, we'd like to also inform to all the members of the audience that as we were awaiting the presence of our Minister, Honorable Minister Shri Sudhir Mungantiwar, now as he's happened to be as a part of the assembly proceedings, which is why he couldn't make it today to the conference, we humbly apologize to all the members of the audience. However, he's conveyed his regards to all of you. He's still part of the assembly proceedings, which is why we are carrying forward with the event. And with that, we'll get started with our final discussion as well. Ladies and gentlemen, once again, I'm going to request all of you to please do fill in your feedback forms. And with that, I'm going to request Mr. Samir to also take it forward from here.
A very good evening to all of you. This is the last session, and we were incidentally supposed to be almost 5 to 6 of us on the panel, but due to various reasons, we are only 3. So what we did is that between 3 of us, we said that we'll have to rejig this session because it cannot go ahead the way we had planned it. We had actually sector people coming up for this session, but we have only now one gentleman from Standard Chartered Bank for talking on real estate. So the way we have redesigned this last session is that each one of us will sort of come here and talk rather than we have a panel running out there, and then sort of we'll share our thoughts on sector or on specific aspects relating to sector, whether tax or reforms, and take you through it. So kindly excuse us for redesigning or rejigging it, but we ensure that we'll bring enough meat in this session to depart a lot of knowledge, and hopefully you'll go home with more knowledge. Thank you.
So for a very quick introduction, I look after real estate private equity business for Standard Chartered Bank. I'll speak primarily about real estate, and if we want to just look at how the budget works for the real estate sector, I think we should just take a step back and put it in context of real estate, where the real estate sector is right now. I'm sure you guys read a lot in the press about how housing crisis is there and what's happening on REITs and so on and so forth. So I will talk about at least 2 major policy initiatives in the budget, one relating to the housing sector and the other relating to REITs, real estate investment trusts. First of all, the housing. What's happening in real estate right now is that housing industry, or the residential, urban real estate in residential sector, is in a state of slowdown. We read so much in the press about that. Even the economic survey, if I'm not wrong, I think recognized that as a challenge to the real estate sector, and it does talk about the fact that there is a lot of unsold inventory in the market, and there is sort of a price build-up that is not sustainable, which has been only sustained because of the investment flows into the sector rather than actual end-user purchase activity. And both these are true. So there is a build-up of unsold inventory in the urban residential real estate across all major cities in India that we track at least we look at 8 to 10 major cities in India. And there is also a price build-up that we've seen over even during the post-crisis 7-8 years time that we've been tracking. But I think real estate sector is probably less understood because it's fundamentally different from every other or most other sectors, in the sense that when we talk about inventory, we are still talking predominantly of residential apartments still under construction. So it's not as if these apartments have been built and developers are having to hold on to them without realizing cash for them, and hence their equity is really stuck in building these. So we're not talking about that scenario. Clearly, we are still talking about inventory which is under construction. So in India, what happens is, for most part, the residential end user, it's purchasers like you and me who go and buy a residential unit, who actually fund the construction. So we buy during construction, we pay in stages during construction, and hence we fund the residential construction. So this context is, once you place it in this context, perhaps the panic, at least what that means is that it's not a panicking situation. The second thing is that, yes, urban real estate prices have gone up a lot, but I think that has been parallel to that, the cost structure, input costs have also gone up. So there are two reasons why costs have gone up. Number one being that the product that you get today is at least 3 generations ahead of what was being built about even 10 years ago. So in the last 10 years, the quality of development, the amenities, what goes into building a residential project has also gone up. The second one is really that the cost of construction, the cost of input materials, cost of cement, steel, labor, etc., all has gone up, and for various reasons. But having said that, there is still perhaps an element of lack of price discovery in residential real estate. It's unlike other sectors because there is no market where the customer can go and figure out what price is right to pay for a residential real estate unit. And because of the fundamental nature of real estate, residential units, the only way to actually increase price discovery is to increase competition. And while the government is doing a lot of right things, I would also like them to increase competition in this sector. And that really hinges on two things. Number one being increasing land supply in the market. So while all the urban land ceiling acts, or most of them, have been repealed by the central government and the state governments, the governments are still controlling the supply of land. Why? Because they decide what land can be developed, what land can come within the master plan, for what land they can give zoning to the developers to build residential housing or offices or retail malls and so on and so forth. And secondly, they control the urban transportation linkages as well. So unless they build a road or bus connectivity to a location, the location is not really buildable. And that then places a lot of power in the hands of state governments specifically, because land development is a state government subject, to actually increase competition and make sure that the prices are maintained at a competitive level. Right now, I would say that is somewhat lacking in the market. The second point to note is that none of our cities were ever designed for the kind of growth that we have seen in the last 15 years. So urban rejuvenation is a very important objective. We all see so many traffic jams, so much burden on the existing infrastructure in the urban areas, and that's also becoming a pressing need. We are seeing urban pollution as a result. We are seeing urban traffic loss of time, loss of productive time, and so on and so forth. So, what the government is doing gradually, what the central government has done in this budget specifically is with respect to affordable housing. So they have given very specific income tax benefit to developers who are building compact urban homes in major cities and tier 2 cities as well, with a cap on area of 30 square meters and 60 square meters. At this moment, there is very little residential stock that's getting built in these sort of size categories. But I do believe that this policy will help spur the developers to build some amount of compact homes in the market, which would be much more affordable to that segment of the customer who's otherwise not able to find anything that matches his budget, his or her budget. So that over a period of time, if the policy continues, should help over the next few years. The thing about real estate is when the policies are brought in and to the time actual results of these policies can be realized, there is a lot of time, because building and developing and delivering to end customer takes anywhere between 4 and 6 years time in this sector. So that is why we will, I think the policy or the budget announcement is welcome, but we will see the results of this over a period of time. The Smart Cities initiative about urban infrastructure is very welcome, because if our industry and our urbanization have to continue, which have a positive implication for our GDP growth and our income growth as well. If these have to continue, then urban infrastructure also needs to be addressed. So these are things that take a long time. A city takes many decades to build and populate. So from a long-term perspective, these are very welcome initiatives. The second area where the government has done a major positive change, is for the real estate investment trusts. What's going on in the Indian market is, in the last 15-16 years, there has been a lot of growth in office development. So as more and more multinationals came in, as more and more Indian corporations grew, they needed more and more office space. And while till 2000 roughly, most developers were building offices and selling them in small pieces to small investors or small owners, that was not possible with the large companies, when large companies were wanting space, because large companies only wanted to lease spaces, and these companies didn't want to be divided across multiple landlords. So over the 15 years, a lot of what was built by the developers remained in their ownership. And as a result, the rental yields, which have ranged between 10 and 15% in the last 10 or 15 years, all the cash flow from the rental yields was going into servicing the debt that was taken for construction of all these office buildings. So really the developer of office spaces did not have an exit. The developer did not have the ability to take his or her cash out of an asset and then reinvest into a new development. So that was creating liquidity stress among the developers of real estate, builders of offices. What real estate investment trust will do is it will allow these developers to offer units in the market backed by all these assets and backed by the cash flow coming from all these leased offices. Government has done a lot. Government and SEBI have done a lot in the last 2 years' time, I would say, in streamlining all the policy initiatives that needed to be taken to allow real estate investment trust to become a reality. There have been some tax incentives or removal of discrepancies in the process as well to allow these real estate investment trusts to become completely pass-through vehicles from a taxation perspective. And the last of those was announced in this budget, in which the dividend distribution tax that would be applicable to these REITs, to distributions by companies to these REITs, has been done away with. And this is, I would say, a very major positive change, and it should give a very significant boost to real estate investment trust IPO plans of many participants. As we speak, I know that at least 5 to 6 large developers or owners of office properties or retail properties are there who would like to go for business trusts or REIT kind of initial public offering. This will also allow the retail investor in India to have an ability to participate in direct investments or indirect investments in property, which is otherwise for a small investor not there. If a small investor wants to have a investment in the property, the ticket sizes have become so big that it's out of reach for many of us. But REITs with their lower subscription amounts of maybe 100,000 rupees a unit or something like that will give the ability to a lot of small investors to participate in REITs as well. And not only to participate, but also get the benefit of diversification of assets that REITs will typically have, because REITs will pool a lot of cash together and buy a diversified portfolio of real estate assets. And these will have diversification in terms of geography. These will also have some diversification with respect to tenants occupying these properties. These will also have some diversification with respect to the age of the asset and so on and so forth. So I think this would be a fantastic opportunity, and this is also a very welcome step. Other than that, there are some smaller clarifications in the budget with respect to capital gain treatment for where the dates of agreement and date of registration are different and so on and so forth, which I'm not going into. But broadly, I think these are all welcome steps, and I'm sure the government also has a roadmap for making longer-term changes just so that the competitive process or competition in the sector only gets a boost, and also longer-term challenges with respect to infrastructure, etc., are addressed. Thank you.
A very good evening, ladies and gentlemen. Samir, Ashish, friends. As far as myself is concerned, you are aware, CA Atul Gupta, presently chairing the two important committees of the Institute of Chartered Accountants of India. One is a National Economic Affairs Committee, the second one is the IT Committee, and remained the chairman of Indirect Taxes Committee of ICI. Finance Bill 2016, Budget 2016, I see with a two perspective. One, that is ease of doing business, stability in policies. And the second one is about the tax GDP ratio. What kind of efforts can be there on the tax GDP ratio? And I was discussing with Samir in a break that if I share with you about the finance bill or a budget as a reformist budget, because why I am saying so, that a lot of brain was put in to deal with this budget, to deal with the provisions, the amendments, as far as indirect taxes are concerned. I divide the amendments, I divide the presentation in the two parts, as I mentioned. One is reformist, the another one is that what efforts we can put into the tax GDP ratio. In the reformist, the first and the foremost aspect which is there in the infrastructure sector, in the core sector, is the stability of the policies. Last year, in 2014, there was new tax regime. The new tax was imposed on the ports and airports, on the construction of the various government accommodations, medicals, hospitals, colleges, and then with the, in respect to the government accommodations. But yes, this time, in this Finance Bill 2016, a benefit was given to the, all these kind of a contractor and the real estate sector, infrastructure sector, that since these projects having a life of say 6 years to 10 years, and suddenly we are introducing a new tax, let us give a benefit to those contracts which are started prior to the change in the policy. And the benefit is now will be available till 2020. So I will see that having a retrospective amendment, the Finance Bill 2016, there is a boost, there is a benefit which is given to the infrastructure sector, may it be the construction of a port, airports, construction of a government accommodations, schools, college, hospitals, and finally to the metro. Yes, the construction of the metro and monorail will be subject to service tax from the 1st of March, but again with the retrospective benefit that in case your agreement was prior to the 1st of March 2016, it will not attract service tax till 2020. Then, my dear friends, the second reform which is very, very important to understand in this finance bill is about the availability of the more and more Senvet credit, for the Senvet credit of the input services and input to the business, to the corporates, to the industry, to the SSCs. Earlier, what was the situation? That in case you are dealing in a taxable as well as in a exempted services, only a proportionate credit in relation to the overall credit was available. But now, they have provided into the scheme of the Senvet credit that apart from the 100%, there will be the 3 segment of the credit. One, which is will be exclusively in relation to the exempted activity, the no credit will be available as we have in the earlier schema. Now, again, there will be a second part that the 100% attributable to your taxable activity. And unlike earlier, as compared to the earlier scheme, there was only a proportionate credit. Now it will be 100% credit available for the credit which is 100% attributable to your taxable service, and it will be only and only a proportionate credit which will be available for the common services. Say you have a 3 layer of credit, 20 lakhs, 4 lakhs is for exclusively exempted, no credit, 10 lakh is for 100% in relation to your taxable activity. The 100% of the credit will be available, and only this methodology to apply, the ratio will be applied only on the common credit, which will be say 6 lakhs rupees. So it will be a more credit available to the industry, as we discuss, even the Ranade discuss about the cess which are not senvetable. The third reform which is into the pipeline, and yes, there was less discussion, no discussion at all about the GST, but I see there are certain changes which are in line with the GST. Say there was a rule in relation to the distribution of Senvet credit to your job worker. That is rule 7, that is input service distributor, and which will be available in the GST regime also. So there are changes which are into the line of the GST, and for the GST you are well aware that GST will be giving a unique benefit. That today, even the Ranade speak about that you are putting a lot of cess. Now, what is the problem of putting the cess? There are 2 problems. Number 1, that cess, if senvetable, if not a cascading effect, then there is no problem, because that is something like a tax only. And the second one, that when you are charging the coal, this coal energy, clean energy cess, and that is against for the electricity which are exempted under the regime of excise, that is become a cost. What I am trying to convey you, that internationally there are 2 concepts. One is exempted and the second one is a zero rated. So if in the proposed regime of GST and even today's regime, even if we are putting certain taxes, there is no problem at all. We are putting cess, there is no problem. But that should not be a cascading effect. Say in the Swachh Bharat cess, we have a 0.5% tax, but that is whether a really 0.5? No. The answer is it will be 2%, because every time the cycle is there. Say you are buying from a raw material, you are paying 0.5%, then you are putting certain value addition and you are selling, then again you will be paying 0.5%, then you are paying to the retailer and wholesaler. On every stage, there will be a 0.5% Swachh Bharat cess, and it will be not a senvetable, it will be a cascading effect. So real impact will be not 0.5%, it will be 1.5% or a 2%. Likewise in the GST, I foresee like for additional tax, that is they are saying 1% additional tax will be there and it will not be a senvetable. So the most important aspect is that whenever you are putting a duty, that should be a senvetable duty, that should be the set off should be available. And the second one, even if you are putting certain duties and you are making the final product as a zero rated, then you are eligible to claim the refund of the tax you have paid. So it should be a zero rated even in today's scenario as well as in the GST scenario, rather than you are putting certain excise duty. Okay, whatever I'm paying in the coal, whatever I'm paying the cess on the coal, if my electricity is subject to zero rated rather than the exempted in the central excise tariff, I will be able to claim the refund from the department, whatever cess or whatever duty I'm paying while purchasing the coal, or even the cess on the extraction or the mining cess or something X is I'm paying. The fourth aspect, which is there in the budget for the reformist perspective, is the common man benefit. Yeah, already discussed by Ashish, that is affordable housing and then slum dwellers. So in case you are a builder, you are into the real estate and you are constructing for the beneficiary land, for the slum dwellers, for the affordable housing and then the state housing project, all will be outside the ambit of the service tax. So the price will go down. Specifically at least 6%, because on the real estate sector 4%, that is 4% is applicable on the housing sector under the scheme that is 30% taxable subject to a rate of 15% around, exactly it is 4.5%. Impact will not be there on the real estate sector, may it be the affordable housing, may it is a slum dwellers or beneficiary land and the state housing project. Now dear friends, I am coming to the second leg of my deliberation, that is the tax GDP ratio. Now, my dear friend, it is very, very important to understand that globally, when we are talking about the World Economic Forum, when we are talking about the World Bank report, what is the situation? That internationally, there are the two terminologies which are being used to understand the tax GDP ratio. One is a tax capacity, that okay, based on your demographic profile, based on your geographical profile, based on your income group, how much tax you can collect into your GDP. And the second one is a tax effort, that okay, as compared to your tax capacity, how much you have collected. And it will be a very surprising note to each one of you that as per the report of the World Economic Forum and number of other reports, we are ranking on the 74th position with a 0.88% effort as compared to our tax capacity. And the countries like Pakistan, countries like Sri Lanka and the other developing countries like Argentina, they are far ahead as compared to India. So there should be a serious concern, there should be a serious endeavor to see that our tax effort should be at least 1% as compared to 0.88% right now with the tax capacity. And while achieving this tax GDP ratio to a level of 1%, we should have the ease of doing business. We should have the doing business rank getting improved. So there should be a fine balance between the tax GDP ratio, the efforts put in for the tax GDP ratio, and the same time we are managing the ease of doing business. And that's why I offer you the three very, very important change which are there into this budget 2016 to match up that kind of initiatives. The first one is the tax put on the levy put on the jewelry. That is 1%. Hardly makes any difference. 1% is not a difference, not a big deal. But that what will be the important, that the more and more SEC, more and more income, more and more expenditure will be covered under the regime of reporting. Because there will be a kind of a reporting by the dealer, there will be a reporting by the jewelers, there will be a reporting, and even like the second aspect which I am going to share with you, that is electricity, the annual information written by the electricity. Likewise, there will be a kind of a more and more person coming into the tax ambit. Rightly mentioned, only 3% are paying income tax as compared to in our country. But gradually we have to increase this, not only on the direct taxes front, but also on the indirect taxes front. Yes, we are paying on a Colgate or on the toothpaste or on a comb, whatever we are buying, we are paying. But still, we are far, far behind as compared to the desired level. And the second change which you will witness very soon to achieve this tax GDP ratio and to have this kind of a reform, that is annual information written from the electricity department. Yes, central excise department and the service tax department, though not on this finance bill, but earlier to the finance bill, have introduced the mechanism that every electricity company, every state electricity board will be filing annual information report written to the Central Board of Excise and Custom, and then one computer will be speaking to the another computer and will be seeing that yes, there are the red flags, there are the areas, there are the gray areas where we can have a more and more stringent verification. There should be artificial intelligence which will be put into the system. Yes, automatically the surveillance will be there. And the final one is something about the annual return. There will be an annual return, my dear friends, in case of a service tax, in case of a excise, as well as in the case of assignment credit rules, which need to be filed first time on the 30th of November 2016 this year, and that return will be required a due reconciliation with the financial statements. So what I am trying to convey you, that yes, we have a 88th rank, we have a 74th rank with a 0.88% effort as compared to our tax capacity. That gap we have to bridge, and that's why these are the changes which are being introduced either through the finance bill or prior to the finance bill, to see that we are improving our rank not only into this Transparency International or doing business internationally, but at the same time in our tax GDP ratio, which is far behind as compared to the other developing countries. So friends, this was all I wish to share with you from this dais. Thanks to the Samir for giving this opportunity. Thank you very much.
Thanks Ashish, and thanks Atul for alluding us to specific aspects of GST, the dynamics of taxes, how taxes get collected and what are the tax capacities. And I think the information that you shared on REITs was quite meaningful and helpful for people to understand. Of course, as I said, the session was supposed to be a panel with question and answer, but we have changed the format. There are some of the sectors which were originally being planned of this panel. So I just thought I made some notes and sort of take you through those sectors as well, as to share what has come in and what's happening in those sectors. So if we start with infrastructure, I think there are two major points on infrastructure. One is whether in terms of land reforms bill, which has not yet seen the light of the day. To make any infrastructure project successful project, there is a need to have this land reform bill to be in place, so that adequate land can be acquired, and then one can go ahead and sort of start the development of the project. And just to give you a small example, Navi Mumbai Airport is being talked about since last 2-3 years. Even as we are talking today, there is a small patch of land which CIDCO is unable to acquire to complete the contiguity of the airport land, and hence they are not able to still float out the RFP. So obviously there was no news, there was no sort of murmur on the land reform bill, but for infrastructure to really take off, this will be one of the critical things. Second is, of course, the situation that we have on NPAs. Most of the infrastructure companies are sort of bleeding, and there are reasons why they are bleeding. It's not that they went aggressive, but to start an infrastructure project itself is a challenge, because as we talked, one is of course land acquisition, but apart from land acquisition, environmental clearances, clearances for sort of getting various other approvals within the state and central government, and then sort of starting the development. So if all these things get delayed, obviously the cost goes up, and if cost goes up, the viability of the project becomes a challenge, and that gives rise to NPA or financial situation in the sector wherever you are. So I believe there are enough hinters given by the FM that they want to lay down the roads. There is a Sagarmala project which is being proposed. So very unique project, Sagarmala, from an infrastructure perspective. It's connecting national waterways. What it means that today if you want to lay down road, rail, you have to incur a cost, because you have to lay down the road, you have to lay down the rail, and then the either vehicles or tracks on wagons will move on the tracks. Here water is available free of cost. You don't have to lay down anything, right? All that you have to do is to get a specific size of vessel, small, medium, big, which can sort of transport cargo. We have a huge coastline, 7,500 kilometers, right, running from east to west. So this can be effectively used and thereby, and of course, there is a proven statistics, I need not allude to it, but yes, transportation by road is the cheapest as compared to rail or road. Road is being the most expensive. But if you look at statistics, the maximum transportation happens by road and we tend to pay higher cost. And if you look at our logistics cost as compared to globally, it's almost 14%. So any product that goes onto the market, the logistics cost would be anywhere between 14 to 16% as compared to globally, which would be hardly around 4 to 6%. So that's the kind of comparison on logistics cost, because our entire movement happens on road. We have been only developing road and the cost is so high, whereas we know water, we have a huge coastline, we can move cargo by water, by laying down appropriate national water highways and thereby reduce the cost. So very ambitious project is announced by Ministry of Shipping Sagarmala, which will connect at least east to west part of India via south through waterways, and that will probably reduce carbon footprint or will be environmental friendly as well as reduce the cost. So that's, and of course there were certain announcements on airports, 160 airports likely to come up. Again, from tax perspective on infrastructure, they have said they will withdraw the tax incentives which are available to the infrastructure sector. So today infrastructure sector enjoys a tax holiday for a period of 10 out of 15 years or 10 out of 20 years. There is being a sunset clause being put, which means that effective 1st April 2017, there won't be any tax incentive or tax holiday available to infrastructure projects. So that will again sort of create its own nuances, but in a way government has promised that it will reduce the tax rate. So there is an arbitrage. While the tax holiday or tax incentives are being withdrawn, the tax rate by that time would come down to 25%, which is today 30%. So that's pretty much on infrastructure. The next one is real estate, which Ashish has already covered, so I will not go deep into it except for fewer aspects where they have announced for affordable housing tax holiday again for developers. And if you ask me, in this budget, the amount of reforms or changes that have come for real estate, I have never seen so many reforms or changes coming in a single budget for real estate sector per se. I mean, you look at REIT, you look at affordable housing, you look at incentives for individuals where if you are unable to acquire a house in 3 years, you don't get tax reduction for interest that you have paid. So they have extended period from 3 to 5 years. So in a normal course, if you take a housing loan and you have sort of invested in an under construction house, if you are not able to get the house within 3 years, then the interest which otherwise you should have got as a deduction of 1.5 lakh comes down to 30,000 till the end of the loan period. So you lose out 120,000 rupees till the tenure of the loan if you don't get house within 3 years. So this has been extended to 5 years. So which means that you get 2 additional years to still acquire your house and still claim that interest of 1,50,000. So a lot of good measures have been announced. We hope with all relaxations in the REIT, we will be able to see at least, if not more, couple of REITs coming on the market at least in this year, and that would sort of gain momentum as we move ahead. The other sector is which I thought we'll touch upon is power. In power, government has announced integrated power development scheme and Uday project. So thus far, power sector has been purely focused only on development or generation side. There has been not enough focus on distribution and transmission. And in this budget, we have a lot of measures being announced for distribution and transmission. So, integrated power development scheme focuses on, again, transmission and distribution. Uday again focuses more on distribution of power. Again, incentives have been announced from tax perspective, where you get additional 20% depreciation for power transmission projects, which is again good news. There has not been sort of lot of talk on nuclear energy, but if you look at few of the visits of our Prime Minister, especially the US and the Australia, what has typically happened is that government has been able to successfully sign nuclear energy agreements, whereby government is able to procure nuclear raw material required for nuclear energy. So there is nothing talked about it in budget, because this is more of public sector, nothing for private sector. But yes, behind the doors there is a lot of action happening on the power. In terms of health sector, to encourage, if you see, India has been sort of making molecules or new medicines based on the discoveries which happen globally, whether in US or Europe. There have been very few Indian origin molecules or discoveries happening in India. To encourage this, government has brought a patent regime whereby an originator of a particular R&D product or a new molecule will be able to register the molecule in India for patenting, and this, if it is licensed anywhere in the world or in India, only 10% of that income will be taxed. So it's a major incentive, where normally your income would have got taxed at 30%, but here by introducing patent regime, they are encouraging people or scientists or pharmacists to get into the discovery of new molecule, and thereby only pay 10%. Apart from that, nothing significant from sector perspective. Of course, there are few major things coming in terms of dispute resolution scheme on tax side and income disclosure scheme. I am not sure in previous sessions this has got covered or not, but these are measures taken to boost tax recovery or tax revenue, or to boost revenue of government, whereby government is hoping that almost like there are 3 lakh cases in litigation in tax, where 5.5 lakh crore is the amount at stake between government and taxpayers. So the idea is to sort of see that how government can settle this 3 lakh cases and see how much they can recover. Even if they recover 25% of this 5.5 lakh crore, it's a huge amount. And that is where government is sort of, it's a very innovative thought, very simple thinking. Government saw this statistics and they said, okay, let's go for settlement, because somewhere people know their case is weak and they will not only pay tax, they will pay penalty. So by doing this scheme, they will pay tax and we will only recover say 25% of the penalty and waive 75% of the penalty. So it's a mutual give and take. If this scheme becomes successful, hopefully we'll see next year reduction in tax rates. Similarly, if income disclosure scheme becomes successful and people start declaring income, we'll again see tax impact on tax rates in future years. Many thanks for patient hearing. In case you have any questions, we would be happy to answer, else we would sort of wind up. Thank you.
Well, thank you very much indeed. Ladies and gentlemen, on that note, the floor is again open for the Q&A.